It's time to assess risk for cash. So I'm going to show you an example of a risk assessment summary form for cash. We'll look at the inherent risk, the control risk, and the risk of material misstatement. But before I do, let me make a few comments. Now, normally for control risk, I will assess at high for each assertion, even if the controls are designed correctly and in place throughout the year. So when I do my walkthrough and I see that the controls are there, maybe they're performing the bank reconciliations on a timely basis, they're doing so for every bank account. So I don't really have any high risk in relation to controls. Even so, I'll still assess control risk at high most of the time, and you might be wondering, why would you do that? The risk is lower because they have controls and they are working. Well, at this point, when you do your risk assessment, you're making a decision about your approach. So at this point, you can either decide to test controls for effectiveness, and by the way, that walkthrough's normally not considered a test of controls for effectiveness. You just simply have looked to see, is the control there and is it designed correctly? So now at this point, we're doing a risk assessment and we're making a decision about whether or not we desire to test controls and then also perform substantive procedures, or what we call test of details. Usually at this point, I'm thinking I can do the test of details. In this example for cash, I can look at the bank reconciliations and test those faster than I can test the controls. So I go to high with my control risk because I don't desire to test the controls for effectiveness. Really what I'm saying is I'm going to perform a test of details. Therefore, I'm going to list my assertions, and we said that the relevant assertions are normally existence, accuracy, and cutoff, those three being the most important. Then also rights and completeness might come into play. So I'll list those 5 assertions in my risk assessment summary form, and then I'm going to go to high for the control risk for each of those 5 assertions. So what does this look like? Well, if you look on the screen, you'll see the 5 assertions listed, and then I've already gone to high for control risk for each of those. Now I simply need to assess my inherent risk, and then my risk of material misstatement out in that right-hand column. It is a function of the inherent risk and control risk together. For existence, we'll say the inherent risk is moderate, so that gives us a risk of material misstatement, and sometimes I refer to that as RMM. That gives us an RMM of moderate. Now, some people would go to high here. You need to just think about what the risks are and what impact it has on total RMM. I'm going to go with the lower of the two and go to moderate. Now, on accuracy, let's say that this particular client hasn't done a bank reconciliation correctly in the last 40 years. And so accuracy, the inherent risk would be high because historically you've had a problem here. Now, inherent risk is commonly a function of, have you seen issues for that particular assertion in the past? It's also a function of complexity. So if you're looking at a transaction cycle that has high complexity in relation to a particular assertion, then you're going to go to high on inherent risk. It's also a function of volume. So with cash, almost always you have a real high volume, and if your volume is high, sometimes you need to go to high with your inherent risk because there's so many transactions. With accuracy, because historically we've had some issues, we're going to high with the inherent risk. That brings us to high in the risk of material misstatement. Now think about what that means in relation to your substantive procedures that you will perform. What this really translates into is you're planning to test the bank reconciliation. So you'll receive the bank reconciliation from the client. You'll add all the numbers to make sure they total correctly. You're going to tick and tie the transactions, those deposits in transit, those outstanding checks to the subsequent month's bank statement, because you're trying to prove that the bank reconciliation is correct. Obviously, you're also agreeing the bank balance to a bank confirmation or to a bank statement. Now, that's the response to the risk. So we've determined that we have a high risk of material misstatement in relation to the accuracy assertion, and because of that, we're going to really beat up the bank reconciliation so that we're confident that it is accurate, that it's correct. On cutoff, in this example, we'll go to moderate, and that'll give us a moderate RMM. On rights, I'm going to go to low. Usually, there's not an issue. The client usually owns the bank account, and we'll go with a low RMM. And then completeness, and I'm going to use an example here that will highlight this second column, which is the fraud or significant risk column. Let's suppose that you believe that there's two more bank accounts that the client has not placed on the general ledger, and because of that, cash is not complete. Furthermore, you believe the reason those two accounts aren't on the general ledger is you think the CFO is stealing money. You think that money's going into those two bank accounts and that he's writing checks out of those accounts to himself, and those two accounts are not even on the general ledger. Because of that, we have a fraud risk, and then we have a very high inherent risk. Now, a fraud risk or significant risk by definition is an extremely high inherent risk. So anytime you have a fraud risk or a significant risk, your inherent risk should always be high. So we've got that here. And then our risk of material misstatement is high. Now let's talk about what that means for a moment. In relation to the completeness assertion, we've said the risk of material misstatement is high. That means we're going to do some substantive procedures and some detailed procedures to see whether or not there's really an issue. There's a material misstatement in relation to this assertion, in relation to completeness. So what am I going to do? Well, some of the things that I might do is I might have discussions with those charged with governance, or I might have discussions with those outside of the accounting department, and I'm really doing a little snooping to see whether or not there's other bank accounts that exist that are not on the general ledger. I might also, and I would, send bank confirmations. Now the problem is the bank confirmations, they usually want you to give a bank account number, and in this instance the CFO's telling you Basically, he's not giving you the bank account numbers. He's really pretending that these bank accounts don't exist at all. So you have to think about, how am I going to test for this potential lack of completeness? All I'm really trying to say is, when you have a fraud risk, you need to link this high risk of material misstatement to detailed procedures that are responsive to the risk that you have identified. Once you've done that and you determine what your risk of material misstatements are for each assertion, then for those high RMMs, you're definitely going to have extra substantive procedures that you're going to perform. If the risk of material misstatement is moderate, normally you would perform just basic procedures such as vetting your bank reconciliation. So that's how I do my risk assessment in relation to cash. Again, bear in mind that every client is different. Every client has different risk. So your inherent risk and your risk of material misstatement might look different from mine. And then you could also, if you wanted to, test controls and then bring your control risk lower than high. So this is a lot of judgment, and it honestly is the reason most CPAs and auditors struggle with risk assessment. It's not like adding 2 plus 2 and you get 4. It's, all these various factors come into play, and you got to use your best judgment to come up with the risk assessment and then a plan to respond to your documented risk of material misstatement.